I have backtested the Bollinger Bands countless times over the years, whether it's for trend following or mean reversion, and across multiple time frames and markets, and I have consistently found them to be among the best performers out there. In a previous video, I showed you how you can combine the Bollinger Bands with candlestick patterns to trade reversals on the Aussie Kiwi. This time, let's trade reversals on the Pound Canadian by making use of the Bollinger Band's free bars. I will explain what these are and demonstrate the programming and backtesting process.
Bollinger Bands consist of a 20-period simple moving average, with a pair of bands plotted at 2 standard deviations above and below it. For short-term reversal trading, these default settings work great. If prices were normally distributed, they would close outside the bands only 5% of the time. In reality, due to noise and periodic releases of economic reports, I estimate the real figure to be between 10 to 15% of the time. A free bar occurs when you have a bar that is completely outside the Bollinger Bands. Mathematically speaking, the bar's low is above the upper band, or for the case of the lower band, the bar's high is below the lower band. Since the entire bar, not just its close, has extended beyond the bands, a prompt rebound is likely to follow, much like a stretched rubber band snapping back into place. It therefore makes sense to fade these temporary overextensions, by going long when there's a free bar below the lower band, and short when there's a free bar above the upper band. Using only one entry condition is likely to give you many false signals, especially when you trade on the lower time frames. First, I want to see prices rebounding towards the Bollinger Bands before entering the market. For long entries, a buy stop will be placed at the previous high. For shorts, a sell stop will be placed at the previous low. Stop orders will be valid for 3 bars. If prices do not rebound within this time, there could be a fundamental impetus behind the price extension, and it's best to stay out of the market. Next, let's add a time filter. Forex markets are open 24 hours, but trading volumes vary significantly throughout the day. Markets are busiest during the London and New York sessions, when high trading volumes often create and sustain trends. It's generally best to avoid these hours, so I'll only take entries during the quiet Asian session. I'll only trade in the 2200 to 0400 range, GMT time. During these quiet hours, there's a higher probability that the price extension you're exploiting is caused by noise. Noise is the random price movement that obscures underlying market direction. It is a result of the millions of market participants transacting for different agendas. Such extensions are usually unsustainable. In addition, if I enter a trade during the Asian hours, I don't want it to be exposed to the high trading volumes when London opens. I will close all open trades at 0400 hours, which is the end of the trading time range above. And finally, let's add in the exits. I'll use the middle of the Bollinger Bands as the profit target. In the absence of any fundamental price mover, you can quite reliably expect prices to revert to the mean, hence the name mean reversion trading. I'll use a constant stop loss of 50 pips. Note that the distance to the profit target will fluctuate due to the expansion and contraction of the Bollinger Bands, so there will be trades where the reward to risk ratio falls below 1. The high win rate should make up for this though. First up is the Bollinger Bands free bar condition. Then we have the stop entry and the exits. And finally the Asian hours time filter. Be sure to adjust the time inputs to match your broker time zone. Now let's backtest the strategy on the Pound Canadian. The Pound and Canadian are generally risk-on currencies, so the Pound Canadian spends most of its time in trading ranges. Lower time frames typically contain more noise. I'll exploit that by trading the 5-minute time frame. Here are the 10-year backtest results. 500 trades is a little low on the 5-minute time frame. At least this means the filters worked. Or did they? Let's find out. I decided to redo the backtest, but with the time filter and stop entry conditions removed. I even removed the need for the bar to be completely free of the Bollinger Bands. The revised long rules are thus. The close needs to be below the lower band, after which we will enter using a market order, regardless of the time of the day. The profit target and stop loss are unchanged. The new backtest is not a disaster, but no way I'm trading that. I always add some sort of entry filter when building a strategy from scratch. Counter-trend trading is a great way to diversify your portfolio and smoothen your overall equity curve. Hope this strategy inspires you to create something that's uniquely yours. Alternatively, you can use Bollinger Bands together with reversal candlestick patterns to predict upcoming reversals. The video at the top right shows you how. To learn how to leverage genetic evolution to automatically build a diversified portfolio, check out the video at the bottom.